Let me take you through something compelling. Silver just dropped 8% in a matter of hours. And if you think this is just another routine market correction, you're missing the most important financial signal we've seen in months. What happened to silver isn't happening in isolation. This crash is telling us something much bigger about the dollar system itself. And the people who understand what I'm about to show you are positioning themselves right now while everyone else is still trying to figure out what just happened. I want you to look at what happened on April 8th. Silver opened strong, actually pushing above $29 an ounce in early trading. The technical setup looked perfect. Momentum traders were piling in. Then suddenly, violently, the entire trade reversed. 8% gone, wiped out. Not over days or weeks, but in hours. And here's what nobody in the mainstream financial media is going to tell you. This wasn't about silver fundamentals changing. Industrial demand didn't collapse overnight. Solar panel manufacturers didn't suddenly cancel their orders. The supply-demand story for physical silver remained exactly the same at 3 p.m. as it was at 9 a.m. So what actually happened? The key insight here is we just witnessed a liquidity event. Not a silver event, a dollar liquidity event. And the difference between those two things is everything. When you see violent price crashes across multiple asset classes simultaneously, you're not watching individual markets respond to individual news. You're watching something much more systemic. You're watching the plumbing of the financial system seize up. Let me explain exactly how this works, because the mechanism here is what reveals the real story. Silver trades primarily through futures contracts on the COMEX exchange. These are leveraged instruments, meaning you can control large positions with relatively small amounts of capital. When silver moves against you, you get a margin call. You need to deposit more dollars immediately, or your position gets liquidated. Now here's where it gets interesting. These margin calls don't just apply to silver traders. The same institutions trading silver are also trading bonds, currencies, commodities, everything. They're running massive interconnected books. When multiple positions start moving against them at once, something critical happens. They need dollars, actual dollars. Not tomorrow, not next week, right now. And when you need dollars immediately, you sell whatever you can sell fastest. That's usually your most liquid positions: gold, silver, treasury bonds. It doesn't matter if you believe in the long-term thesis. It doesn't matter if you think silver is going to $100 eventually. When you need to meet a margin call in the next 4 hours, you sell what moves. This reveals something important. The price action we saw in silver wasn't traders suddenly deciding silver is worthless. It was traders desperate for dollars selling everything they could to get those dollars. That's a liquidity crisis. And it was exactly what happened in March 2020 when supposedly safe. Treasury bonds crashed alongside stocks. Everyone needed dollars all at once. Now, pay attention to the timing here because it matters enormously. This didn't happen in a vacuum. Look at what was happening in the broader markets that same day. The dollar index was surging. Treasury yields were moving erratically. Currency markets were showing signs of stress, particularly in emerging market currencies. These are all symptoms of the same disease, dollar shortage. I know that sounds insane to people who've been hearing about money printing and inflation for years. How can there be a dollar shortage when the Fed printed trillions? This is where everyone gets confused, and it's exactly what the financial establishment wants. Because if you understand the actual mechanism of dollar liquidity, you understand why everything we're watching unfold was completely predictable. Here's what they don't teach you in economics classes. The dollar is not just American currency. It's the global reserve currency and the foundation of a massive offshore banking system that dwarfs the domestic U.S. economy. When a company in Japan needs to borrow money to buy equipment, they often borrow in dollars. When a bank in Europe makes a loan to a corporation in Brazil, that loan is frequently denominated in dollars. The entire world runs on dollar credit. But here's the trick. These offshore dollars, these euro dollars as they're called, aren't created by the Federal Reserve. They're created by private banks making loans. And when economic conditions deteriorate, when uncertainty rises, banks stop making those loans. They tighten lending standards. They reduce credit lines. And suddenly the supply of dollars in the global system starts shrinking even while the Fed is supposedly printing money domestically. The Fed can print reserves, they can expand their balance sheet, they can buy bonds. What they cannot do is force private banks to make loans. They cannot force the euro-dollar system to expand. This makes all the difference. Because when that offshore dollar system contracts, when those credit lines get pulled, suddenly everyone who borrowed dollars needs to find dollars to pay back their loans. And there aren't enough dollars available to do it. That's when you get a scramble, a panic, a liquidity crisis. And that's when silver drops 8% in a day, despite nothing fundamental changing about silver itself. Now, let me show you why this particular crisis is different from the ones we've seen before. In March 2020, when liquidity dried up, the Fed stepped in with overwhelming force. They cut rates to zero. They launched unlimited quantitative easing. They opened swap lines with foreign central banks to pump dollars into the global system. They basically told markets, we will provide unlimited liquidity, whatever it takes. And it worked. Markets stabilized. The dollar shortage eased. Assets reflated. But here's what's changed. The Fed can't do that anymore. Not without completely abandoning their inflation fight. Not without admitting that the entire tightening cycle was a mistake. They've painted themselves into a corner, and the people running the system know it. Look at the Fed's recent statements. They're still talking about keeping rates higher for longer. They're still talking about inflation being the primary concern. They're still pretending they have the luxury of maintaining tight monetary policy. But behind the scenes, something very different is happening. The plumbing is breaking. Again, this is where everything comes together. The Fed is trying to maintain the illusion of control while the actual dollar system is showing cracks, and silver, gold, commodities, these are the canaries in the coal mine. When you see violent dislocations in these markets, when you see price crashes that don't make sense based on fundamentals, you're seeing the stress underneath the surface. Let me give you some context for why this matters right now. The US government is running trillion-dollar deficits. They need to sell enormous amounts of treasury bonds to fund those deficits. Who's buying those bonds? Primarily, it's been the Fed through quantitative easing and foreign central banks, particularly Japan and China. But both Japan and China have been selling US treasuries recently, not buying them. Japan needs to support their own currency. China is reducing dollar exposure for geopolitical reasons. So who's left to buy? Domestic institutions, pension funds, banks, insurance companies. But those institutions are already loaded up on bonds. They don't want more exposure at current yields, especially when they're worried about inflation coming back. This creates a problem. The government needs to sell bonds. Nobody particularly wants to buy them at current prices. What happens? Yields have to rise to attract buyers, but rising yields means falling bond prices. And falling bond prices means losses for everyone holding bonds. Banks take losses. Pension funds take losses. Those losses reduce their capital. Reduced capital means they need to sell other assets to meet regulatory requirements. They need dollars to cover those positions. And suddenly, we're back to the same liquidity scramble. You see how this connects? The silver crash isn't about silver. It's about the impossible situation the entire dollar system finds itself in. The Fed needs rates low to keep the government solvent and prevent a liquidity crisis. But they need rates high to fight inflation and maintain confidence in the currency. They can't have both. Something has to break. And what breaks first? The most leveraged, most speculative positions? Silver futures, gold positions, crypto. Anything where traders are using maximum leverage to amplify returns. Those positions get liquidated first when margin calls hit. That's exactly what we witnessed. Now here's what worries me most about this particular episode. The recovery, or rather, the lack of it. In previous liquidity events, once the immediate selling pressure was exhausted, prices bounced back relatively quickly. Smart money stepped in to buy the dip. This time, silver has remained under pressure. The bounce was weak and unconvincing. That tells me the selling isn't finished. That tells me there are more positions that need to be unwound. More margin calls coming, more dollar shortage ahead. Pay close attention to this. Watch what happens in the repo market over the next few weeks. The repo market is where financial institutions go to borrow dollars overnight, using bonds as collateral. It's the shortest term lending market there is. When repo rates spike, when borrowing becomes expensive or difficult, that's your real-time indicator of dollar shortage. That's the market screaming that liquidity is drying up. In September 2019, we saw repo rates spike from 2% to 10% overnight. Nobody saw it coming. The Fed had to step in with emergency repo operations, eventually leading to them restarting quantitative easing, though they refused to call it that. We could be heading toward a similar situation right now, except this time inflation is higher, which limits the Fed's ability to respond. The institutional players understand this. The big banks, the hedge funds, the sovereign wealth funds, they know the game that's being played. That's why you're seeing such strange behavior in markets. Bond yields aren't behaving how textbooks say they should. Gold is volatile despite inflation concerns. Currency markets are dislocated. Everything feels unstable because everything is unstable. And into this instability, we have geopolitical tensions escalating, trade relationships fragmenting, supply chains still recovering from pandemic disruptions, energy markets distorted by the war in Ukraine and Middle East tensions. All of these factors increase uncertainty, and uncertainty makes banks more reluctant to lend, which tightens dollar liquidity further, which leads to more liquidation events like what we just saw in silver. The people who positioned themselves correctly ahead of March 2020 made fortunes when the Fed finally responded with massive stimulus. The people who understand what's happening right now have a similar opportunity. But the timing is everything. Move too early and you can get crushed by deflationary liquidations like we just witnessed. Move too late and you miss the response when the Fed inevitably has to step in again. Here's my read on where we are in the cycle. We're in the breakdown phase. The phase where the tightening finally starts breaking things. The phase where all the leverage built up during years of easy money starts unwinding violently. This phase is dangerous. It's when assets can fall dramatically, even if the long-term thesis remains intact. Silver dropping 8% in a day is perfectly consistent with this phase. But the breakdown phase doesn't last forever. Eventually, something breaks badly enough that the Fed has to respond. A major bank fails. A sovereign debt crisis emerges. Treasury auctions start failing. Some piece of critical financial infrastructure seizes up completely. And when that happens, the Fed abandons the inflation fight and floods the system with liquidity again. That's when assets explode higher. That's when the people who accumulated during the breakdown make their returns. The question everyone wants answered is, when does the breakdown phase end and the reflation phase begin? I don't have a date for you. Nobody does. The Fed itself probably doesn't know because they're reacting to events, not controlling them. But I can tell you what to watch for. First, watch the Fed's language. When they start shifting from inflation concerns to financial stability concerns, that's your signal. When they start talking about supporting market functioning or ensuring adequate liquidity, the shift is coming. They won't admit they're backing down from the inflation fight. They'll frame it as technical adjustments necessary for market operations. Don't listen to the words, watch the actions. Second, watch what breaks. Is it regional banks again, like we saw with Silicon Valley Bank? Is it a pension fund that took too much interest rate risk? Is it a foreign country that can't roll over dollar-denominated debt? The specific trigger matters less than recognizing it when it happens. When something significant breaks, the Fed's hand gets forced. Third, watch gold and silver themselves. When they start rising despite dollar strength, despite stock market weakness, despite everything that's supposed to make them fall, that's telling you smart money is positioning for the reflation trade. That's institutional players accumulating ahead of the Fed's response. Right now, after this 8% crash, silver is either a screaming buy or it's about to get much worse. I genuinely don't know which. That uncertainty is exactly what this phase feels like. Maximum confusion, maximum fear, maximum opportunity if you get the timing right. What I do know is this: the structural factors driving dollar shortage haven't been resolved. The government still needs to sell trillions in bonds. Foreign buyers are still backing away. Banks are still sitting on massive unrealized losses from bonds they bought at lower yields. The offshore dollar system is still contracting. None of that changed just because silver crashed 8%. So the underlying pressure remains. The liquidity stress is still building. And eventually, something gives way. Either the Fed capitulates and provides liquidity, or the system breaks more severely. Those are the only two options when you have built a global financial system on dollar credit, and that credit is contracting. The mainstream narrative will tell you the silver crash was about strong economic data suggesting the Fed will keep rates higher longer. They'll point to some jobs report or inflation number and say that's why silver fell. Don't buy it. The real story is dollar liquidity stress, and that story is much bigger and more important than any single data point. The financial media isn't going to explain offshore dollar markets to you. They're not going to walk through the mechanics of how margin calls cascade across interconnected positions. They're not going to tell you that the Fed is trapped between inflation and financial stability. That's not their job. Their job is to provide simple explanations that don't require you to question how the system actually works. But you and I both know the system is more fragile than they admit. We've seen the cracks before. March 2020, September 2019, the 2008 financial crisis. Every time, the solution has been more dollar liquidity, more Fed intervention, more expansion of credit. And every time, that solution creates the conditions for the next crisis. We're living through the early stages of the next crisis right now. The silver crash was a symptom, an indicator, a warning sign for those paying attention. The people who see it for what it is and position accordingly will do very well. The people who dismiss it as normal market volatility will be caught unprepared when the real breakdown accelerates. So what does all this mean for you? It means understanding that we're in a fundamentally unstable phase of the financial cycle. It means recognizing that violent price moves like we saw in silver are symptoms of deeper structural problems. It means watching the dollar system more carefully than stock prices or commodity fundamentals, because when dollar liquidity seizes up, everything else becomes secondary. It means being prepared for more volatility, more unexpected crashes, more moments where markets gap down for no apparent reason and everyone scrambles to explain it after the fact. And it means understanding that this volatility, this chaos, is actually opportunity if you know what you're looking at. The crisis is here, not maybe coming, not building in the background. Here, now. The dollar liquidity crisis has begun. Silver dropping 8% in a day is proof. And everything that follows from here depends on how quickly people wake up to what's actually happening beneath the surface of these markets.